Anyway, thank you for your time. It's my pleasure today to talk to you about the benefits of tri-party repo, and really to tell you why you shouldn't be afraid of it. The reasons why it's not only for the big and the brave, so to speak, and really to give you the full rundown. So, as Catherine kindly said, I'm on the sales side. I'm a senior sales manager for UK, Ireland, South Africa and the Americas, selling collateral management tri-party repo services. Just to give you a brief background of who we are, what we do. I mean, Clearstream itself are a AA rated institution. We are a neutral service provider, so we're more of an infrastructure bank rather than an investment bank. So we have the strength of the Deutsche Börse group behind us. They are our owners. And within our group, we also have organisations like Eurex, Large Derivatives Exchange, Eurex Clearing, CCP, and also recently the FX platform 360T have recently joined the family. So it's nice to get those guys on board. With regard to tri-party repo, we've been doing this for over 20 years. So it's our bread and butter, I suppose. We spend a lot of time doing this type of product. And as an organisation, I suppose we have assets under custody of about 12 trillion, covering about 54 markets. So that's on the custody and settlement side. In the tri-party repo side, we have over 475 companies that are signed up to tri-party repo. So it includes all the normal relationship banks that you would probably trade with, the central banks, commercial banks, broker-dealers, insurance companies, asset managers, and of course corporates. Now, corporates are very important to us, but before I go on, just to give you an idea of figures, we have about 650 billion within our program on a daily basis within sort of tri-party repo. So it's a very huge business from our side. So corporates for us, we've been doing the corporate treasury business for a long time now. We've always had corporates on board. They have historically tended to be more of the larger multinational type corporates, so obviously larger balance sheets and probably more mature in the treasury desk side of things. But I'd say in the last 2 to 3 years, it's really been a huge focus for us onto the what I would call the vanilla corporate treasury world and the vanilla corporate treasury cash. I remember we attended a corporate conference about 2 to 3 years ago. I won't mention the conference that it is because I don't want to embarrass the people that were attending at the time. And at the end of the conference, there was a panel of 4 major corporate treasurers sitting on the panel, and we were very fortunate to be able to text in a question, question to the corporate treasurers themselves. And my colleague who was sitting next to me is obviously a lot quicker at typing than me, and he happened to type in a question to the corporate treasurers: would you see tri-party repo as an investable secured form of financing? And 3 out of the 4 corporate treasurers on that panel said, we can't answer that question. We don't know what a tri-party repo or repo is. And that suddenly opened our eyes and realised that we've got a lot of work to do. And it was just, it sort of hit home really that our product, although it's well known in the marketplace, within the corporate treasurer side of things, it needs a lot of work, and we needed to do a lot of marketing on that. So, why should corporates be interested in repo or tri-party repo collateral management? Well, I suppose it's the obvious one is it's moving your cash from the unsecured market into the secured market. I suppose there's no reason these days why you should be placing your cash unsecured with the same banks that you currently trade with, who are in fact were looking to trade with you on a funded basis against collateral. I say the banks actually that we speak to, with regard to the regulatory issues that are coming up, that they're not comfortable taking cash on an unsecured basis because basically it's inflating the balance sheet. So if you're currently investing euro unsecured, you've probably had conversations with your banks and say, look, we don't want to take this anymore. We can't take it. The only way that we can look to take it potentially is on a secured basis. So it's all these factors that have sort of pushed people towards that, looking at that secured financing type of thing. There's also been things like the threat of bail-in risk. So what happened in Cyprus a few years ago, I know it's probably a very small case, a very small country, but there is threat that potentially that could spread elsewhere. You've got money market fund reform. Of course, money market funds, I'm not saying that we're replacing that business. We do a lot with money market funds. In fact, we have money market funds as collateral within our program. So we work very closely with the money market fund providers. But the fact is that, there's a will they, won't they, change the VNAV, CNAV, CNAV to VNAV, will they become unrated? It's just a question that seems to be always on the lips of the regulators. And also there's the ability to reuse collateral within our program as well, or within Tri-Party itself. So basically, if you're a collateral receiver within Tri-Party repo, you could then reuse that collateral to reuse onwards, maybe with a CCP, for example, to go an OTC exposure you have on the derivative side. So it's all these various terms of things that you can use that collateral once you have it within the Tri-Party collateral management area. And of course, finally, you've got regulation, Basel III, and the evolving needs of the financial institutions. The fact that they're looking to term cash up for their LCR purposes, for net stable funding ratio, taking cash from a corporate far more advantageous than taking that cash from a non-bank financial, from a bank financial. So these are all mitigating facts of why corporates should really consider tri-party repo. So I suppose that then begs the question, well, if that was the case, then why aren't all of you guys currently doing tri-party repo now? Although we have worked very hard in the last 3 to 4 years to get you on board. And as I say, we've got a large number of corporates that are currently trading within our system. But I suppose one of the biggest barriers to entry has always been documentation. And the conferences that I go around Europe, around the world, that have repo or gets discussed about as a talking point, documentation is always one of the biggest factors. Now I'm going to go into a bit more detail on that in a minute. But so that's one of the biggest factors there. The second one, I think, is the banks themselves. So your relationship sales managers who talk to you on a daily basis, talk to you about CDCP, all the other wonderful bank products that they promote. But it tends to be that repo doesn't get mentioned in these sort of conversations. Well, for us, we tend to deal with the repo sales funds, the funding desks within the banks themselves. So what you have is a disconnect between the corporate sales relationship managers on one side of the bank and the funding desks within the banks themselves that are crying out for secured cash, but never the twain shall meet. They're not speaking to each other. One doesn't know the other one exists. And most of the time these guys are sitting on the same floor. They're probably sitting 10 yards away from each other. So part of my job and part of our role has really been to educate both corporate sales guys to tell them what their repo sales, repo trading guys are doing potentially on the same floor as them within their same organisation. So that's been extremely difficult to start with, but we're gaining traction on that side, and I think it's all about that understanding side of things. We even do briefings for the banks themselves. So there are a couple of banks I deal with where I'd actually go out and we arrange a corporate briefing for the corporate clients. They come in, I'll talk about tri-party repo, and the banks would obviously talk about levels and all those wonderful things. But then I also do the briefings interbank as well, so it does seem quite strange really. I'm sort of marrying the two together in a way. And I think another misconception is that tri-party repo is just for the big boys. The fact is that you've got to be trading yards and yards off your balance sheet, of your unsecured cash, to be able to trade a repo. Well, that's no longer the case. Maybe it was the case a number of years ago, but things have changed. And, clients can now invest smaller amounts of cash. We've got clients that are putting, 1 to 10 million of cash in repo. And, as long as their relationship banks are happy to take that, then, we're happy to set it up as well. So it's no longer a product just for the larger organisations. I'm talking a lot to local authorities at the moment who, of course, although don't have massive cash reserves, but they do have a lot of residual cash that they put away for long term. So it's really the term trades that they're interested in, and the banks are willing to take that type of cash as well, especially if you look at some of the UK banks taking that cash against sterling. So just going back to the documentation side, I think we've tend to simplify that over the last 2 years, and that's always been something that's put organisations off. And there's something called the GMRA, which is a Global Master Repurchase Agreement, which basically it's a bilateral agreement between one counterparty and another counterparty to allow them to trade repo within, basically. Now, historically, it can be quite expensive to set up, and also it can be quite time-consuming. So from a corporate's perspective, it tends to is put them off on that side, because basically, obviously, it's a long-winded proposal, and also if they're looking to trade with another counterparty, say they have 5 or 6 banking relationships, it can become quite expensive. On the banking side, exactly the same. They want to trade with 20 or 30 different corporates, but they don't want to set up a GMRA with each one. So the way that Clearstream would come around that, sorry, I'm going to mention Clearstream once here, if that's okay, is that we come up with something called the Clearstream repurchase conditions. Now, the repurchase CRCs, as we call them, another abbreviation, basically it's a one-stop shop, which it's a multilateral agreement, which means you sign that document once, you can then trade with anybody else within the Clearstream tri-party program that's also signed up to the CRCs. Now, not everybody has signed up to the CRCs. Some people still prefer to trade under the old GMRAs. But what it does do, it gives you a quick entry into that tri-party repo world. And for us, it's been groundbreaking. It's been, I suppose, for the corporates that we're bringing on board now, I would say 99% of those corporates are coming on board with the CRCs. The relationship banks that they trade with, I would say 70% of those banks are currently signed up to it, and the other 30% are currently looking at it as well. So it's been out probably about 2 years, and we've maybe got 65 to 70 organisations signed up so far. So that documentation process has been simplified. The normal steps would be set up an account with Clearstream or your tri-party repo agent. It would mean various KYC, which you would do for opening any other standard bank account. So you sign that, you need to sign up to either a GMRA or CRCs, and then you sign what's called a collateral management service agreement, which is basically, again, an umbrella agreement, which then allows you to trade tri-party with any other counterparty within the tri-party program. And then the only other thing you need to be concerned about is your collateral schedules. So that is the collateral that you're willing to accept as a cash provider. And again, that's all completely up to you how you want to set that up. I suppose there's other factors that you need to consider. Obviously, you need to consider how you're going to trade. Fortunately, there are a number of ways out there. We ourselves have our own portal that you can instruct trades. There you can use trading platforms. You've got 360T, have a tri-party module within their program. Bloomberg also have a tri-party option within there. And of course, you've got other trading platforms like DBVX and NewEdge as well that offer these C2B, B2B, B2C type trading platforms. I suppose another key factor is the fact always getting questions around event of default. Well, in the event of default in the tri-party, the collateral is ring-fenced and the collateral then goes back to you. The rightful owner transfer a title that you can then liquidate and then get your money back on that side. And I suppose one of the important things within tri-party, and this is probably the thing I should have mentioned first, is that the golden rule of tri-party repo is that the collateral giver always pays. So as a cash provider, it costs you nothing. It costs you nothing to set up. You can have it set up tomorrow and you may not use it for 6 months, but it's not going to cost you a penny. Any trading that happens is always, the cost is always borne by the actual collateral receiver, collateral giver themselves. Other services that we offer at Clearstream, we do things like marriage broking. So although you may have some relationship banks you currently trade with, well, we can actually go out and actively find you new banks that potentially you could trade with that you haven't thought of before or you haven't got a relationship with already. So that would mean looking at your collateral requirements and then marrying you up with potential counterparties that fit your various credit and risk criteria. I'm doing for time. So just a quick one on the sort of type of securities that are eligible. Of course, we're going down from the more vanilla government bonds, corporate bonds. We now have a lot of corporates that are now looking at equity baskets, that are trading on equity baskets, and now we're also moving into the fund space as well. And I think that's the way that maybe the market is moving. I think if you're looking to be a collateral taker, looking at some of those more the high HQLA, the high quality liquid assets, obviously going to be harder to come by going forward. So I think it's all about your risk appetite as a cash giver. So it's all about if you're willing to come down the yield curve, obviously you're going to get the pickup with regard to the type of rates you're going to see. So again, the unsecured versus secured world really depends on your risk appetite itself. So we have some corporates that are very happy to take very low quality, unrated collateral because they see their risk is against the counterparty rather than the risk against the collateral that they're willing to take in. And so on things like the euro, if they're looking to go out to term, they can potentially look at positive spread on the back of that as well. Because what they're saying is that we currently place our cash unsecured with you Bank A already, and we're getting X rate. We can take the same, or we can give the same cash to you guys against very low quality collateral, but we can get a better rate. So at least if anything happens to you, we've still got something to show for it, which is it's quite a strange phenomenon, but that's the way the market is, because the banks that are holding on to this lower quality collateral need to get it off the balance sheet, would like to do it against secured funding. And then on the other side of the spectrum, we've got other counterparties that are really using tri-party repo as an insurance policy. So basically they want to take the high quality assets and they're willing to pay up for that. But what they see, they say, well, you know, if anything goes wrong, we know that we've got these assets and we can liquidate. So in summing up, because I realise I'm going on a bit here, tri-party repo, the documentation has been made easier. It's not the big bad beast that people thought it was, and we as tri-party agents have tried to simplify that. I'm not just talking Clearstream, but I think the market in general. Talk to your banks. I think you'll find that the banks push your relationship sales managers. I think you'll find that they are willing to go down the secured route. I mean, in this day and age, should you be placing your cash unsecured when you've got the secured option? Maybe not. And you'll tend to find that the rates could be better than the unsecured market. I mean, I've saw some rates recently from some of my clients, and they're comparable, if not better, depending on the collateral and depending on the term. You've got the automation of trading. So I've mentioned the various platforms that we've got out there. Obviously, the ability to reuse collateral as well is extremely important, and it will be going forward with the potential mandatory clearing of derivatives. And I'm not quite sure what the date's going to be now. It seems to keep moving. And as I mentioned before, it's not just for the big boys. I mean, we're taking on smaller ticket sizes, and say we're talking local authorities. There is potential there. And again, finally, I'd say it costs nothing. It's completely free. I mean, can't be a better sales point than that. And I'll end on that. And thank you for your time.